Back with closing trades, and we've now got Mr. Alok Agarwal of Alchemy Capital Management joining us on the show to give us a slightly broader view of the market and how he's reading into the market texture right now. Alok, hi, good afternoon. Good to be speaking with you. I remember the last time we spoke, you've eternally been bullish on India, and you did mention last time that you believe that the bad news is already priced in by the market and now it all looks good. But ever since then, we've been absolutely range bound on the market. Do you believe now everything that's happening on the geopolitical front has been positively priced in, and sooner or later we are going to see a one-way up journey for the market? Is that how you're looking at it?
Yeah, hi, good afternoon. Pleasure being
Hi.
here. Yeah, as you rightly pointed, what not has happened in the last few months, especially when amidst an energy shock, the kind of results that we had, a 10-quarter high earnings growth for the Nifty, and the mid caps and small caps even higher than the Nifty earnings growth. So those numbers are pretty positive. We are seeing rationalization on the GST side from the government, as well as RBI rate cuts that is getting transmitted to the economy. And their private consumption is also coming up fine as the manufacturing is booming. All these things have been there along with a lot of FI selling in the last 6 months. Despite that, the markets have been pretty resilient. You don't have too many economies that are growing at close to double digit on their nominal GDP side, and corporate earnings growing a notch higher. And despite this energy shock, markets are still slightly below the point where they started out the year. So for us, the risk reward has improved tremendously. But yes, the index has been far more range bound, primarily because the lot of heavyweights in the indices, there the growth rates are little suspect. The broader economy, which is led more by the manufacturing side, that's there in the mid and small caps, or maybe the smaller large caps, those are doing pretty fine. So yes, this being at the lower end of the range that we are seeing in the last few months, the risk reward is definitely attractive. But yes, we prefer the broader markets over the top names.
The broader market at this point, Alok, give me a sense of what's looking good within the broader end of the market. Are you adopting a more top-down or a bottom-up approach right now, and sectorally, what looks fit right now?
So in fact, look at the sectors that are delivering consistently higher earnings growth, and the visibility of future growth is also higher. If I were to name them, things like especially the whole power sector's value chain and the electrification theme, followed by the manufacturing-oriented capex side names like defense, then the industrial metals, the precious metals, the pharmaceuticals, and capital markets. These 6, 7 segments have been growing at a pretty higher pace and pretty consistently as well. But interestingly, most of them have very little say in the main headline indices, that made me say that attraction is in the broader markets. Majority of the growth is in the broader markets. The index heavyweights like oil and gas, large private banks, IT, FMCG, which is like major heavyweights in the main indices, there the earnings growth are pretty slow. So due to which our preference for those sectors which are actually outside the index.
Let's talk about the heavyweights on the flip side. Alok, talk to us about your view on IT, on banking. Let's start by talking about IT. How are you looking at this entire AI play in IT right now? We keep getting updates on that front very frequently. Earlier in the day, in fact, yesterday, TCS has announced a very big partnership as well, a new deal coming in. How are you looking at your main headline IT players, the larger caps versus the mid caps? And within that too, would you be preferring the mid caps over the large caps?
If you look at the overall IT space in India, the main companies are dominated by the IT services. And there has been a lot of debate as to how the AI would impact their demand and overall growth going forward. But even if you try to simplify the same, even without AI, when the AI wasn't there, if you look at the last 3 year, 5 year, or 10 year earnings growth of these IT companies, as a sector, the earnings growth has been just short of 10%. They are barely touching 10% mark. With AI coming in, at least it's not going to be a tailwind. How much of a headwind will it be? Only time can answer. But a 10% mark or a double digit mark in itself isn't too attractive. So until and unless the growth visibility improves meaningfully, it's difficult to be too constructive on the sector, especially at a time when there are multiple other sectors that are growing at a much better pace that have been ignored for a long time in the last 10, 15 years. So that's why our view on IT isn't very constructive. But at the same time, there could be select few names in the mid-cap space in the IT also, which are niche areas which are doing pretty well, and there the earnings growth is better. But at a sector level, we are negative.
Good. Alok, give us your sense on how you're looking at financials. Within financials, is it banking? Is it NBFCs? Are you looking at insurance as a play right now? What looks good?
So far, we had been preferring and continue to prefer the non-lending space led by the capital markets, especially the exchanges and the AMCs. But within the lending space also, especially if you look at the overall banking credit growth, that number is coming at a good high mid-teens number. And that's a very, very healthy number to have. Only if we can start seeing some deposit growth also kicking in, there will be some kicker in the form of FCNR deposits too. And if we can see those margins standing up, the net interest margins, that will be a very big positive for the lenders, especially the private banks. And as it is, we are seemingly in a cycle where the yields are and the rates are headed higher and not lower. And in a rising yield scenario, the banks have an edge over the NBFCs, so due to which within the lending space, we prefer the banks. But yes, overall, our preference has been more towards capital markets, followed by the private banks.
Good. Also talking about some domestic facing themes, Alok, you've spoken about banks in terms of the capital markets themes that you like, financials, I mean, and that's largely inward facing. How are you looking at power, defense, some sectors that are largely inward facing and are to more or less sheltered from the kind of geopolitical movements that we're seeing globally? How are you placed when it comes to both of these sectors?
No, in fact, we have been most bullish on the overall manufacturing segment itself. And the most consistent among them is the power electrification theme as well as the capex theme. If you look at our India's GDP constitution also, close to 15% of that comes from manufacturing. And the government has been talking and trying to take actions to ensure that that contribution rises. You know, power demand is very highly correlated with the GDP growth. And if the manufacturing contribution rises along with the improving income levels of the people, the demand rises for power at a faster pace than the nominal GDP. At the same time, we have announced, tax breaks for data centers for hyperscalers in India. So we are seeing a bigger growth in the overall power demand and the whole value chain around that, right from generation to transmission to the equipments and all the infra around that power side. So that makes us extremely positive on that. That also feeds into our role into the overall AI capex boom we are seeing globally. Defense,
Thank you.
on the other hand, is a very different story. We are seeing the rising geopolitical tensions globally, and overall, the world spends about 2.5% of GDP on defense. Senses with more and more interdependence going down and self-dependence going up, uh, each of these countries have to spend far more on their own defense. I wouldn't be surprised over the next few years if we go and hit closer to a 6% mark as a percentage of GDP which is spent on defense, something that we last saw during the Cold War times. So both these segments extremely positive, triggers are different, but the long runway of growth is ahead of us.
Understood. So you're extremely bullish when it comes to defense. Alok, on that note, thank you so much for your time. Wonderful to be speaking with you today.